Welcome, ladies and gentlemen, to yet another Grey Market Talk with Thorsten Wegener, that's me, former market maker, but with my special guest, let me pick him up, Nic Themistocles, former market maker, head of trading, market vigilante, managing gazillions of US dollars, euros, pounds sterling, and every exotic currency you could possibly think of. Nic, thank you for being my guest. We already had, well, over an hour talk right now, so at the moment I'm considering, are we going to publish the crap we are talking about now or the 1 hour discussion we had before? What do you think?
I think we start again.
Yeah, let's take all the swear words out I used when you called me back on. You can't put that on air. Anyway, thank you very much for joining me, Nic. We had an exciting week. Let's dive into the couple of slides that crossed my attention. And obviously, as the highlight of the day, I discussed that with my students yesterday evening already. Apparently, nobody has anything to do. They're all sitting at 11:30 out there and discussing markets and what happened in the Middle East and you name it. And I thought, well, I'm interested what Nic's take will be, what the next week will bring to our shores. And we shall get into that towards, not the end, but towards the highlight of the show. And now I'm looking for my bloody share button, share screen. You tell me when you can see it. Can you see it?
Yeah.
So we have the 12th. No, we don't. We have the 21st. See, I have to check. 21st, that dyslexic. 21st of April, 2024. And I thought I'd start with a motivational slide. Maybe for next week. I found that quite fitting. Some days it's hard to find motivation. Some days motivation finds you. It's a cyclist being chased by a bear up a road. So yeah, even if you're lazy, don't want to do anything, sometimes there is the urge to do something, because if you don't do anything, you might lose money or not, or you might make money if you have been of a short disposition. Anyway, this slide we used last week, and I really like that. I call it cycle time, and it gives the basic idea how a cycle works. And we all agreed last week that we had been all the time in the tricky, expensive, but momentum likely runs side to the upside. Has that changed now, Nic?
Well, we said it's expensive. Momentum, I'm not sure whether it's reached a stumbling point here, and that's the most interesting bit. What you've seen from last week, majority-wise, is what we thought would happen with these large caps. So the likes of Apple, Microsoft, Nvidia, Supermicro, they all took a bit of a bath. Whereas actually, if you look across the market, some of the smaller cap stocks, they weren't so bad. So, it's what we thought. Large caps will take the index down, but it won't destroy the underlying market.
Well, I'm glad to hear that, even though I don't really have an opinion on what's going on. Well, I have a tactical opinion. That's why I call it the tactical brief, right? But we're going to discuss that later, as we did in the green room beforehand, what it actually means for a longer-term investor. We have here. There was one slide I had to bring in from James Bianco. It hit my LinkedIn box, and I called it Trust the Numbers. And let me just read the beginning to you. For the guys who are just listening to it. Below the numbers, that's what James Bianco says, of initial filings for unemployment insurance. How is this statistically possible? 5 of the last 6 weeks, the exact same number. Effectively the same number in the last 11 weeks, except for the holiday weeks, President's Day and Easter. Consider, the US is a 28 trillion economy and has 160 million workers. Initial claims for unemployment insurance are state programs with 50 state rules, hundreds of offices, and 50 websites to file. Weather, seasonality, holidays, and economic vibrations drive the number of people filing claims from week to week. Yet this measure is so stable that it does not vary between even 1,000 applications a week. Just the number of applications incorrectly filed out of every week should cause it to vary more than this. And we raised that topic over and over again. Can we still trust the numbers, or is it all big bullshit, Nic?
We know that these things are all going to get revised. And so you can trust the number only once it's about 3 months old, once they've had a chance to revise it. But the big, let's wait for the Friday unemployment number. Once you got that number, you had your sort of like 5 minutes flurry in the market, as it were. You've got to sort of really think is that number still going to be there in 3 months' time? And usually, and historically, it's been proven it's not. So it gets revised quite a lot. And now you can see from this great post, I must say, I didn't notice that, that these things are kind of just made up.
Isn't that interesting? With all this technology we have now, and additionally on top now, artificial intelligence, the quality of the numbers seems to be completely arbitrary.
In the, I must say, this is really one of the only places, the employment numbers are one of the only places where you see some really big revisions. Otherwise, I must say, when you compare the US to the rest of the world, the US have some absolutely fantastic in-depth analysis by themselves of their own position. So on the whole, they're really good. And it's just this sort of, you found the one that's really awful.
Yeah, what number is politically the most important?
Yeah. Well, at the moment, it's a toss between unemployment and the inflation numbers. But even there, they do decide which one they want. The core X shelter, X energy, and all of this stuff, which is not a bad thing. But the headline one is very noisy. But you're right. This is very, very sensitive number.
Yeah, absolutely. So we already mentioned inflation, yeah? The two numbers that actually the guy on the street like us really interests. Do you keep your job? And how much is stuff going to cost you at the pump or whenever you pay your bills? And this was a slide from Yahoo Finance, the source, Bureau of Labor Statistics, the guy who faked the employment numbers just the slide beforehand. But this is something, obviously, where you have to be a bit more cautious in tinkering with, because, well, you can't really revise. If people like you, I, or pretty much everybody who's listening, who has paid their car insurance the last months, has realized it's gone up dramatically.
Yeah.
It's the biggest driver here. Auto insurance is up 22%. And I wondered, where that's coming from, Nick? Of course you do. Was just a setup.
You're going to tell me.
It's the bloody EVs, because they keep on burning, and if they have an accident, they're completely destroyed. They are write-off, and insurance companies have to take that into consideration. So the new modern, beautiful world where we all drive electric vehicles has increased insurance premium between 20 and 30% for cars. Thank you very much for that, right?
Indeed.
Rent.
Obviously, it's an interesting number. But the contribution to CPI is relatively small. The bigger contributor to CPI is the next number down, which you've got is rent at 5.7.
This looks, if you live in Germany, this looks comparatively modest in the United States, up 5.7%. We in Germany have at the moment the problem that we have open borders. We have a lot of people coming in, a lot of people who do not have a lot of money. They need to be sheltered somewhere. We have big problems already. However, at the same time, our enlightened politicians make all the rules for building new houses more and more expensive. How are they going to do that? All the sustainability stuff that has to go in. They have to be insulated. They have to have this heating system. They have to this, that, and the other. So I really don't know how they're going to square this circle to say, oh yeah, our housing has to become more and more efficient, thereby being made more and more expensive. At the same time, we keep the borders open and start a huge competition on the lower end of the pay scale. Who is able to afford reasonable accommodation? It's a nightmare happening here.
There are 2 points to this, and that is this large immigration also influences the US number, perhaps not as much as the European number or the German number, but there's also another anomaly in the US number. Is that the rent, which is roughly about 35% of CPI. When obviously, when it's growing at 5.7%, everyone gets really excited. But the real rental rise in the States is actually fairly flat. But this is something called owner's equivalent rent. So what they do is they go and ask somebody who owns their own property, and they say, well, if you were renting it, what do you think you'll get for it? And of course, you're not going to say, well, I mean, I wouldn't get very much for it. You'd say, oh, I get a lot for it. And that's how this number, this 5.7% is distorted from reality. I had a look at some actual rental increase numbers versus this number, and it's night and day. It's totally different.
So you're saying it's actually too high what they're quoting here?
Yes, absolutely. And you know, as I say, the actual rent, if you go and look at sort of, you know, there are websites in the US, as I say, the US is full of this data. You go and say, look at what the average rental increase is for chargeable rent, as opposed to something you make up yourself for your own property, is far lower than, as I say, it's fairly flat, 1-2%, something like this, you know, at least inflation level, real inflation level, as opposed to this thing, which is majority-wise made up because it's based on a survey of people who own their own home. So 25%, if you like, of the CPI is the owner equivalent rent. The actual rent number is 35%, but the owner equivalent rent is the majority of that number. So it's distorted tremendously. And then one more question. Okay, so you are the Fed. You've only got one toolkit at the moment, which is interest rates. You know, you've done your QT. You've forgotten about that one. What the hell is interest rates going to impact auto insurance or rent when you know there's immigration coming in and you're asking people the wrong question? So, you know, big question on the Fed's role in reducing interest rates.
So not as bad as it seems at the moment. Still, we have the situation in the US for one part of the population. They are sitting on cheap mortgages, which they opened up a couple of years ago. I'm one of the lucky guys as well. I've got mortgages below 1% for my properties. Fine. What are you going to do? Are you ever going to dissolve them? No, you're sitting on it.
Absolutely. And that's right. But the difference is, I think in Europe, I don't know, maybe in UK, definitely, I think you can transport your mortgage. In America, you can't transport your mortgage. It actually sort of is tied to the property. So that's why people stay put. That's why they don't put their houses on offer for sale. And that's why you get distorted property valuations and price movements and rental calculations and all of this palaver. But obviously, they've got this big advantage. They can get 30-year mortgages. And a lot of them have. So that's not where the problems lay with higher interest rates. You won't get these guys.
I had fun with one of my banks, actually. I called them because in Germany, I think it must be all over the world the same. You have the so-called Vorfälligkeitsentschädigung. If you get out of a mortgage, because you want to sell your property, and then you don't pay interest anymore, you have to pay them some money because, well, yeah, that was the original contract. So I thought, oh, that's very interesting. Let me call my bank whether they are paying me money now. Because, well, it must be clearly beneficial for them. No, surprisingly, they won't. Yeah, so
yeah, that's a surprise. You know, banks are great.
Well, I was pretty sure that I knew the answer, but I'll ask anyway. There might be an arbitrage on this.
It's an interesting question. I'm sure, you know, there'll be products in the future where you can do that. But, you know, for now, we have the system that is the system.
So what are energy prices if we are in a heightened or highly tensioned position at the moment because of the Middle East? How is that going to impact the inflation numbers?
Well, I mean, firstly, my view on inflation is that inflation is a monetary phenomenon, and the issue of energy prices going up is a supply thing. It is a short-term impacts on the market. They're not long-term, number one. And number two, you know, the energy market, that's it's not been doing well, I must say, in spite of the, you know, what you might feel would be a classic, you know, where the traders go in, they say, oh, I'm in trouble in the Middle East, let's go and buy some oil. That's not worked out too well.
Not seeing that, yeah, surprisingly. Anyway, we discussed that quite lengthy before, and I thought that's an interesting point actually to then get you into the screens to give you a short-term outview. I remember a long time ago when I started reading books about markets and stuff. There was an old chap, Andrei Kostolany in Germany, a fantastic speaker and prolific writer of investment books, for the normal guy on the street who wanted to get in. In one of his early books, he said, if you invest money into a company, let's be honest about it. The only money you'll ever see back from this company when you are the owner is dividends. Yeah? Forget all about buybacks. Forget all about special stuff that might come in and how we interpret market. If you invest in a company, the only money you will ever see if you don't own the majority of the company and can give your friends and yourself huge contracts is the dividends they're paying out. And I get that. Yeah, people are buying the future and they're buying growth rates and their dividend rates will rise. But I think he brought it to the point. And this chart from Kobayashi letter, which surprisingly I've mentioned now a couple of times because they come up with these beautiful charts in the show, shows simply the 3-month yields, treasury bills, going back to 29 up to today versus the US dividend yields of the S&P 500. And you see this big spike we had that was during the internet bubble in 2000, when stocks were actually providing no dividend yield for the risk you were taking. But we are now clearly above levels we have seen through the 60s, 70s, 80s, and 90s. What's the interpretation of that for you, Nic?
Well, I think that's this is really the point of value of the bond market versus the high valuations in equities we got today. And this book that you read from Costellani may well be the case for many years ago, but the recent history, at least in the States, and I'm looking on my left here, I took a screenshot of an article, and I really wish I could find out what, I'm going to go back and look at the page, see if I can find it. But what it shows me is that sort of the dividend yields are relatively low. So it says here that in the 2000s, they averaged 1.2%, 2010s, they averaged 2%, and so far in the 2020s, up to 2023, they've averaged 1.6%. And the majority of money that you get is from earnings growth. So the earnings growth is really the bet that you're taking with, when you're buying an index, an S&P index, you're betting on the earnings growth. And I think the forecast for earnings for this year is about 8%. So let's just say you have 1.5% dividend, 8% earnings growth. So that's 9.5%. So what's the factor that now sort of stiffs you at the end or gives you the big kicker? And that's going to be the change in the earnings multiple. So if you say that PE, forward price earnings ratio, is 20 in the States, CAPE it's about 35, but you say it's about 20. If you think that that number is going to go down to, let's just say 19, then you will lose 5% from the calculation that you just did. 1.5% dividend, 8% growth, say 0.5% growth, that's 10%. And if the PE drops to 19, you've lost 5%. If the PE goes to 21, then you've made, and this is really the bet that people nowadays are taking. And that's because, the growth factor is a much bigger, this whole tech theme is a much bigger factor in sort of, the types of companies that are now in the stock markets. There are a lot of growth companies. We used to be in the industrial world. Now we're kind of service industry, but also tech. And so the formula has changed somewhat. And the point I want to get to is that, when you look at these valuations and you look at things like excess CAPE, that's the cyclically adjusted PE ratio, and you sort of look at the yield value of that, you subtract the 10-year yield, you subtract inflation, and that you only get left with 1.5%. And what that shows you is that if you are worried about multiples in the States and you've got one of these ETFs, which is just sort of a blanket thing, and you're full of these expensive large caps, and that PE multiple drops down, suddenly the value of holding equities is giving you a less total return than a bond portfolio would do if bonds stay where they are, right? If you hold it to forever, till maturity. And this is the point right now, is that we are at strong valuations, and you're always going to be vulnerable to a pull back down to the average. The average is a lot lower than where we are today, and that's the situation that creates charts like this, and puts people into the into the question mark: should I be owning equities or not? Well, yeah, true. But we hold equities for a different reason, and that's something we still haven't spoken about.
Yeah, is that a big?
That's the first thing I'd say. Valuation.
is that a big fat red warning sign for you then, what we are seeing here at the moment? Because as just to get the whole question out, because as I see it at the moment, taking your argument, it holds as long as money keeps purchasing power, right? If the currencies default, then this is not a problem. Then you would have the Venezuela or the Weimar Republic scenario.
Absolutely. We have a different scenario, but let's take that scenario out. But does that worry me that we're at this situation? And something I've said a good few times in our conversations is that the excess cape is supposed to give you an idea of just how much you will earn over inflation-adjusted treasuries over the next 8 to 10 years. And it's very narrow. But my view on that is that the cycle that we're in right now will last for a good couple of years. I said sort of 2025, maybe 2026. And what that means is that I expect all of this return to be front-loaded. So this excess 1.5%, imagine that it's not every year. I think that's all front-loaded now for the next few years. And I think the returns after 2026 and 7 and so on will be a lot lower. So, right. But I think you have to play cycles here in such a market.
I agree with you. Absolutely. So that was fear and greed last week. We were neutral, and I said, well, neutral, I wouldn't use that as a contradictory indicator now. It's people have to lose their willingness or happiness to go in gung-ho. And once they do that, we have room to the downside. We've seen that now last week. Yes, we have seen a correction here, and we are now approaching, or we are in fear territory, according to CNN. You don't need CNN. You just have to look at the market. NVIDIA took a dive of 10% on Friday alone. And that actually brought us all to the question. Let me stop sharing my screen now, where I want to get your magic tools in as well. We have seen, or we are at the beginning of a correction. The levels, surprisingly, the chart technicians went for the win again. I mentioned that as well. Everybody was looking, what are we doing at the 20-day moving average? We dipped below it. Then we simply put out a chart, put in a couple of trend channels. That's the first stop at around 5,000. Then we have a gap, which we have to test. We are now at the bottom of this gap, which we have tested. We have not reached it by 1 or 2 ticks. Maybe there's another, opening on a Monday with a low, get all the stop losses triggered, and then move up into the correction. So my short-term take on this is we could open a little bit lower and then bias all the day up, and we will eventually go into a correction rally, which will ultimately fail. I can't tell you when this will fail, but that's why I want to bring you in and your chance. Maybe you can give us a better idea. What is most likely going to happen in the short term, Nic?
You need to allow me to share.
Oh, see, I could have done that straight away. You got it.
Now, we haven't practiced this, so hang on. I have to.
Hey, no problem. I was listening to a podcast from Thoughtful Money earlier on, and they had 2 minutes dead air while they were trying. So obviously, in the editing process, they missed something out, and they were trying to fiddle around with Zoom. And let me share that. And then you heard in the background, I have to find.
Okay, I mean, then I am. How should we say?
I see you now on the screen. Fantastic.
I'm forgiven if I screw it up here. So this is. There were 2 views on the S&P. This was the preferred view that effectively, if you look at the bottom left here, so when was that? That was March 23, wave 1, wave 2, and we are completing wave 3, looking for a wave 4 correction after we have visited, this is the fascinating thing, after we have visited this territory here, which was the reverse Fibonacci target up here. And the territory of the pink line here is the reverse Fibonacci of a sort of a previous move in the S&P. It's coming up here. This thing here from Jan 22 till November 22. This rally, reverse Fibonacci target, is this pink point, or these pink lines here, this pink area. And it's hit that point almost perfectly. So not a bad point to stop and pause. And if that is just a pause, we want to see a correction, which is of similar length to its wave 2 counterpart, which is here. And the width is actually, the timing wise, it's practically the same. If I move my cursor, it says April 22nd is the exact same in length to the previous wave 2 here. So for that reason, this is, if it's going to stop, it should stop here. And we looked at the gap earlier on in the green room, and the gap was here. The previous low was 4946, I think we worked out. So as long as we're above 4946, technically the gap is filled, and you can go off to the races and say that's fine. The alternative count to this, of course, which is a much more bearish interpretation, is that this move from the low of October 22 down here has formed 5 waves, and we are at the top of this channel, and we'll visit the previous faults. And here are the support levels here, 4.8. You can see the Fibonacci points on the side, 4.6, not 5. So it really is quite an interesting juncture. What happens next? And I think really the answer is looking at the large caps, because my belief in the bear move has been driven by the fact that large caps should get hit for 6. And the question is, have they been hit enough? And look at the one that's probably suffered the most. This is my Apple chart, daily Apple chart. So this correction, it's in a correction. So far, it's only done 3 waves. If it's going to be bad, then it will continue to, if I just click this, it would tell you the kind of likely path. The first stop point will be, the major stop point will be 145, then rally up, and then down to 120. But at the moment, it's corrected in 3 waves. And as you know from my sort of teaching of Elliott wave, anything in 3 waves, if it stops there, is a correction. So we have to really critical that that Apple doesn't do anything too nasty lower from here. And I think, and you can see this correction has finished in the previous 4th wave. So if it is a 4th wave correction of some kind in Apple, it has finished in the previous 4th wave, which is what you would expect. So the answer to your question is it going up and down? The fact is, if it doesn't stop here, it's going to be ugly. That I think is the only thing to say. I've got shorts in all of these things, Apple, Microsoft, and Tesla, and all of the stuff. You will be unwise not to take some profits on shorts. Is how I intend to play it. And against that, it's interesting. Gold, we still haven't sort of really done anything too exciting on gold, because that's the other side of the equation. You're short something, you're long something else. Gold at the moment, and that's the against the euro. You see gold hasn't, this is the chart that we pulled out before. The kind of target's got to there, it's gone down. It's really not done very much. But if you look at the momentum down here, it's sort of waning. This bottom panel here, momentum is waning. So we've been looking for a correction. Correction just can mean sideways only, not collapse. But the things that should be going up, gold, are pausing. The things that should be going down, large caps, are going down. Question is, do they hold here? If they don't, it gets ugly.
Well, we have seen a substantial correction in some of the large caps, and I'm actually I got this chart yesterday. We have the earnings bonanza for the Magnificent Seven coming up now, right?
Well, there you go. I mean, I just sort of quickly on one of the I have my own signals. So I have a short-term signal and a large long-term signal, and you can see that the short-term signal pointed on. This is the S&P. This was the first sell signal since April the 4th. First sell signal since the 2nd of November 23. Anything small doesn't count. It's got to be much larger than that. It's got to be negative 3 or something. It hasn't. So this was quite significant. I sort of told my guys that this is a very, very significant thing. You can see that this area here, this is a volume-based indicator, which I use freely available to everybody. And it shows that there is some support at that level. And my long-term signal, you see, I have this green line here on vertical is my stop point for a long position, and it's turned neutral. So it's basically saying, okay, don't do anything here and don't do anything until you get a bear signal or not. So technically, again, the other side of the things that I look at, technical indicators, it says pause first before sell, if there is another sell. Anyway, I'll let you carry on.
So the question now I'm asking myself, that is obviously extremely short term. It's for next week. What's the positioning? I've already mentioned it. I'm inclined to say, oh, let's see how we see the opening. If we see the market coming in weak and hitting 1.5 or hitting half or 1 standard deviation to the downside, and then see signs of recovery, we have the correction within the correction in front of us. How long that will take, I don't know. And I don't believe that we'll see new all-time highs from here now, because sooner or later, the economy, especially when we look at the, let's not call them fake, but the weird numbers we are seeing here from the Bureau of Labor Statistics and all the other things coming in, then we're almost back to the original teaching. The stock market should actually tell you when the economy is about to crash, and maybe that's the first signs we can see here. Technically, I'm on the side that we'll see a recovery, a short-term recovery here now, because the market seems to be oversold and we have entered the fear territory. And the big major caps, they already had their correction. Yeah, maybe people think, "Ooh, oh, well, I want to get me some of that." And when I looked at Nvidia on Friday, minus 10%, sorry, that's surely enticing all the let's buy some upside calls and squeeze the market makers out, because we see a brutal rally to the upside. I might be wrong with that, but that's how I'm going to play it.
Yeah, I mean, what you see in front of you is the 10-year Treasury yield. So I think this does play quite a significant role overall in the whole macro picture. And we saw it last time that the markets didn't like yields at 5%, even though higher yields means the economy is growing. But right now, high yields are also providing a great enticement not to be in stocks, and we talked about that earlier. So the higher this thing goes, the less interesting stocks become just for the alternative investment thing you've got. And this band I've got, this sort of 450 to 475 band, is a Fibonacci band as well. And we stopped right at exactly at the 78% retracement here at 470. And if this thing does hold, it's okay. But if yields start to go up towards 5%, yeah, I don't know. We were up there before and they didn't like it.
Well, it fits nicely into the chart we had earlier to say, okay, dividend yields compared to what you get in the bond market. It's a question, is that going to destroy the equity markets as we have seen it here before? No, it's we discussed that also in the green room. I saw the high yield market perfectly right and managed not to make any money out of it, and even wasted my premium because I ran out of street. Yeah.
Yes, I had one of those on the S&P on Friday as well. So ran out of room.
Yeah, that's the expression. So we could go. That's the conclusion everybody loves. We could go both ways right now that we've established. We are at a crucial point right now here.
It's a crucial point. I think this gap thing, 4.6, was it 4.946? I think we said, if it goes much below that, don't like it. If yields go above 475, I definitely don't like it. And I think the rest of the market won't like it either. And then we go into that sort of really bad world. But currently, if we kind of hold these levels, it's not bad points to cover some shorts. I certainly will be on Monday, if I'm around Monday lunchtime.
Good, lovely. So let's finish here. And we had a short and snappy, good conclusion to the markets. And I can only thank you, Nic. I always find it enlightening, especially when your chart on the yield hits exactly the points the lines predict. Yeah, it's a bit like magic.
We didn't talk about Bitcoin halving either, but you know what? There's always time to talk about Bitcoin.
There's always time for that. So if you enjoyed our little show with our, well, take on the market, what could be, and our brutal honesty about how we got it right and still didn't make money on it, subscribe, like, and share. And I hope we'll see you after an exciting week where you will make lots of profits, or at least not lose anything, next week on Sunday. Thank you very much for that, Nic. I enjoyed it thoroughly, as always, and sooner or later, we are going to publish our green room talks, but I will have to bleep me all the time.
We got to be careful about that. You did publish one of my green room comments, which will bite me one day.
And the one day
when I become rich and famous.
And the one day when you got me without beard.
Yes, indeed.
Thank you very much, and hope to see you next week. Bye-bye.
See you. Bye-bye.